Cryptocurrency, the stock market, and startup investing. In this video, I'm going to share with you the similarities and differences between each of these three different asset classes. I'm also going to share what your potential ROI, return on investment, is across each one, aka how much money you can make. I'm also going to share how much money you can get started with across each of these. I'm going to share the potential risks across all three and where you can get started. I'm going to link a few different websites down in the description below. I'm also going to talk about my experience using most of these different platforms. And I'm also going to share some final thoughts before you invest in any of these asset classes. Now, I want to put a big disclaimer out there. This is not financial advice. I'm not your financial advisor. This video is simply for entertainment purposes. Know that investment has risks, so make sure you do your own due diligence before investing in anything. Now that we've gotten that out of the way, if you're new to the channel, what's up? My name is Ferris. I'm the co-founder and CEO of a global technology and media company with a distributed team that spans over 10 time zones. On this channel, I talk about building startups and investing in startups. So if you're an entrepreneur or you're an investor and you're looking to take your ideas to the next level, make sure you subscribe to the channel. Now, the first thing I want to do is make a quick overview of each of the three different asset classes. And when I say asset classes, all I mean are investment types that share similar characteristics. So for example, real estate is an asset class. Maybe it's a home, a condo, or a complete complex or a building. And then of course we have public equities. A public equity might be a publicly traded company, something like Apple, Tesla, or Google or Microsoft. And of course we have cryptocurrency. These are digital currencies that might be something like Bitcoin, Ethereum, or a number of different altcoins. And of course we have startups. And startups are privately held companies that are not available to be traded on a public exchange like Tesla, Apple, and Google. Now, if we talk about each of these individually, let's start with cryptocurrency. We're talking about crypto. It's a decentralized digital currency, and decentralized is really important because unlike fiat currency like the US dollar, the euro, the peso, the yen, these are issued by the government. So when we're talking about cryptocurrency, it's something that is decentralized, and so there's no owner institution. It's really a democratic, I don't want to use the word democratic, but it's decentralized in nature because no one actually owns it. It's by the people, for the people. And the total value of this entire asset class is just over $1 trillion as of the making of this video. Now, there's a number of different cryptocurrencies. You've got Bitcoin, Ethereum are the two largest, and there are potentially, I think, thousands of different altcoins. And these are different types of cryptocurrency, and they all have different purposes. When we're thinking about what is the return on investment, if you were to buy some part of Bitcoin, or you buy one Bitcoin, what can you expect in terms of appreciation? Remember, you want the value of your investment to go up in the future because that means it's an appreciating asset. You want to be in an appreciating asset class. Owning a car, for example, is a depreciating asset most of the time. So we're talking about Bitcoin as an example. Since 2015, it has returned 3,500%, meaning if you had one Bitcoin at that time, now at the time of this video, one Bitcoin is about $40,000. Maybe at 2015, it was less than $100 or just a few $100s. So you're really going to multiply your money really, really fast. In the last 3 months of 2020, the return on investment was 160%. So you might be thinking, wow, this is incredible. Put all my money into this. This is amazing. Not so fast. There was a single day in 2020 where the value dropped 35%. Now, it's really important to understand the potential risks here because while in the grand scheme of things, in the long run, the value seems to have gone up, this asset class is relatively new. I believe it's only 12 or 13 years old. And so because of that, it's really volatile, meaning the price fluctuates significantly. And that's something you need to be aware of because if you purchase some sort of Bitcoin or Ethereum or any other cryptocurrency, the value could literally be cut in half in a week's time. So you just have to know that in the back of your mind when you're thinking about doing this. Now, how much can you get started investing? Like, do you have to buy one Bitcoin? I don't have $40,000. Or, I see another cryptocurrency is X amount. Is it better to buy a cheaper cryptocurrency? Not necessarily, because you can buy fractional amounts. So I believe you can buy, or you can split up like a Bitcoin into 1/100 millionth, which is really good because if the value of one Bitcoin eventually becomes $1 million or $10 million, you're not going to be exchanging with such large amounts. So it's good that you can invest, and there's a number of platforms we'll talk about where you can actually acquire just a fractional amount. I believe actually most of them allow you to buy one piece. So you can buy, 1/4 of a Bitcoin, and maybe that would be $10,000 in today's value of what one Bitcoin is. So these are called fractional shares on a number of different platforms. Just something to know about in terms of vocabulary. Now, in terms of risk, we already talked about the volatility. So it's going up and down. The value is really difficult to predict. You can't actually predict it. Technical analysis doesn't really get you very far, especially the values that cryptocurrencies are at today. So keep that in mind. It's very volatile. And also in terms of security, this is something that's really important because since there is no federal institution, for example, in the United States, if you have cash sitting in the bank, it's insured up to $250,000. So if the bank collapses or something like that, something that's unlikely to happen, but it could, the government will actually back you up and will give you that $250,000 if you have that invested, up to $250,000. There is nothing really to back this, so if you were to be hacked or the network or the exchange or someone were to steal your cryptocurrency via like your private keys or you gave someone your information or they had all of this, that would be bad, so don't do that. But there's a security risk that adds a little bit more complexity to this. But there are a lot of pros and cons that you need to evaluate. In terms of where you can get started, there's a number of different platforms. There's Gemini and Coinbase, which are two of the biggest that I've used personally. Those are awesome and you can check them out. There's a lot of other platforms out there, but there's really only about 5 to 10 big ones. There's a lot of scams out there. This goes back to the risks of platforms posing to be the two that I mentioned and others, and they'll try and get you to sign up your information and send money to it. That's no good. So make sure you do your homework, do your due diligence before engaging in one of these platforms. And in terms of my final thoughts, I did mention the altcoins. This basically means anything that's not Bitcoin. There's also something called stable coins. These are actually backed by a government-issued currency. So for example, there are stable coins that are backed to the US dollar. And so their value is supposed to be 1-to-1 to the dollar. And so they're not gonna have this kind of crazy volatility. At the same time, they're not gonna have any kind of a return potential in terms of asset appreciation like something called Bitcoin or Ethereum. So again, I'm not giving it financial advice, but those are the two that I would keep an eye on, Bitcoin and Ethereum, and that's what I hold my largest positions in. So if you have any questions about cryptocurrency, there's a ton of other resources out on the web. Let me know what you guys think in the comments. Now moving over to our next asset class, these are stocks. Yes, we love stocks. These are publicly traded companies. So you're basically owning a piece of Apple, a piece of Tesla, of Microsoft, of Google, and the total market value of all the publicly traded companies, and I believe 14 or 60 different exchanges around the world, is around $69 trillion. So 70 times the size of all of the cryptocurrencies put together. It's $70 trillion. When we think about returns, there's an index called the S&P 500, which is some of the largest and profitable companies in the United States market. And there's a lot of them in there, obviously. And so you get a good average of what potential returns might look like if you invest in one of these indexes, not a specific company per se. In 2020, the return was 16% in this index. In 2019, it was 28%. Now, the last couple of years have been phenomenal for the S&P 500, specifically the NASDAQ, which is another index which tracks a lot of the technology companies in the market. So you don't really expect a 28% return every single year. That's not really sustainable. If we look back at the last 100 years of the public stock market in the United States, it's averaged about 10% return per year. Some years were negative. Some years, like you saw in 2019 and 2020, were way above that. But the average is about 10%. Also keep in mind inflation. Inflation averages about 2% per year. So the value of the dollar is actually being devalued over time. So that 10% is really more like 7 or 8%. It's also interesting to note when we're talking about Bitcoin, because there's a limited supply of it and it's not government issued, because there's a finite supply, the value will actually only go up. But if you purchase in something like US dollars, that is being devalued over time. So it's something to think about because the value of the dollar is going down. And so of course we're expecting the value of these companies, we need them to go up just so we can beat the rate of inflation. Now, what can we talk about in terms of how much you can invest? So honestly, a lot of these companies, platforms that we're going to talk about, you can invest as little as $1. You can buy fractional shares of these companies. It's important to note that the price of a stock is irrelevant to the value of the company, meaning there could be a company like Apple with a $100 stock. There's another company called Amazon with a $3,500 stock. So is Amazon 35 times more valuable than Apple because the share price is 35 times X? No, that's not how it works. You have to understand the number of shares outstanding. So just because the stock price may be higher or lower than another company, you can't actually compare them like that. You can only compare the stock to its existing value from the past. So if Apple stock was $50 a year ago and today it's $100, that is a fair appreciation. You can't compare Apple stock and Amazon stock even by industry or anything like that. That's not really how it works. So it's something to keep in mind. There's also, in terms of risks, it's important to note that there's different types of companies with different growth profiles. Other companies pay out dividends. So there's a lot of companies that their stock price doesn't really appreciate, meaning it doesn't really go anywhere. It might have been $20 for the last 10 years. However, some of these companies pay out dividends, meaning they take their profits and rather than getting the value, they basically just pay out shareholders. So maybe they yield 5%, 4%. So if you have a $100 stock, they're going to pay you $4 per year as a shareholder just to hold that stock. Sounds pretty good. If you can find a company that is growing and paying dividends, that's awesome. So it's something to keep in mind that not every stock is built the same way. Not every company is built the same way in terms of appreciation and dividend yield. A lot of companies don't even have dividends at all, especially if it's a growth company. There's also a lot of volatility, not as much as the crypto world, but this volatility comes from different sources. So you can have volatility from the world market. So in 2020, we had a once in 100-year pandemic, and so the stock market crashed in March. Some of these companies had no change in business at all, but their stock price fell 20, 30, 40, 50%. And really has nothing to do with the actual business. And a lot of these companies are in those funds. So when the market crashes, these funds and all the companies in it go down at the same time. The company's stock can also go down in price or up in price based on the actions of management, meaning the company might not actually make any more revenue or be any more profitable, but the value of the stock can go up or down based on market sentiment, based on how people feel, based on how emotions are run. So that's something to keep in mind, especially in the short term. In the long term, a lot of that sort of subsides and we go back to fundamentals in terms of revenue, profitability, earnings per share, things like that. But in the short run, it can be pretty volatile, but not as volatile as the crypto market, not even close actually. Finally, let's look at where do you get started? How do you invest in these public companies? We've all seen the videos of Wall Street and people, with tickets and pieces of paper and they're yelling at each other, Wolf of Wall Street. That's not exactly how it works. That does happen in real life. However, you as an individual, as a retail investor, you're basically going to go and set up a brokerage on a mobile app or on a computer, and you can use sites like Robinhood or Webull, and you can do those fractional shares. There's also online web platforms that are amazing, M1 Finance, Fidelity, I have Chase. There's a number of different banks, and most of them offer a lot of these financial services and wealth management to help people invest with stocks. And finally, some other things to keep in mind. Of the three that we're talking about, public market investing is the safest of these three, right? You have liquidity, meaning at any point you can sell your position in these companies. Now, I kept it at a beginner level. There's a lot of things that can make this more complicated, including margin, options, puts, things like that. You don't need to worry about any of that because at the end of the day, if you own a piece of Apple stock and for whatever reason you need to get out of it and you need that cash, you can sell, whether it's a loss or a gain. If it's a gain, you're going to have to pay taxes. Otherwise, it's the safest of these three. It also is not a good idea to try and time the market. So similarly, I'd say for crypto, for all of these, you can't really time the market. So the value of being in the market is better than trying to time the market. And a majority of people in the world today who are wealthy or have acquired wealth have done so through the public market. Certainly there's other asset classes that provide appreciation. A lot of people have made great money in real estate and investing in different things. However, a majority of people have made their wealth or at least preserved their wealth by investing in the public market, by volume, by dollars, by everything. Every metric, the public market for the last at least 100 years or so, that's where a lot of it has taken place. Now, finally, let's talk about startups. This is my cream to the crop. I mentioned in the beginning of the video, I'm the CEO and founder of a tech company. We have raised financing, so we've had investors invest in our company. If you want to watch a video how we raised $600,000, now up to $1 million, I'll link that video down in the description below and how you can do so for your own company. I've also invested in over a dozen different startup companies that are private and they're not available on the public market. So when we're talking about a startup company, basically you are being an angel investor in an entity that is private operation. So it's owned by one person or a group of people, or there's other investors, and it's not available on the public exchange. This company will go on the market, or it's not on the market, and you can invest for a limited window of time when the company is raising financing. So unlike, the public market, where you can go and invest in Apple stock anytime the trading hours, so Monday through Friday, 9:30 a.m. to 4:30 p.m. Eastern time, you can't really do that with a startup. There's a limited window of time, only when the company is raising financing. And normally the company's valuation is anywhere from, $1 million or less, all the way up to a few $billion. And quite frankly, if you're watching this video, you're not gonna have the opportunity to invest in a startup that's $1 billion. Most likely, you're gonna be investing on one of these websites we're gonna talk about, where the valuation of the company is anywhere from 1 to 20 million, more likely between 5 and 10 million. And normally in that investment round, the company is going to be trying to sell about 10 to 20% of the company. So the company, if they're valued at $10 million, is raising $1 million to help execute the strategy so that the company can grow and be valued more in the future. So you as an investor can invest anywhere from $100 all the way up to $25,000 or $100,000 in that round. Now, if you're investing through one of these equity crowdfunding platforms, Regulation CF, some of them offer a minimum as low as $100 or $50. If you're doing a private investment with a company that's not raising on one of these platforms, their minimum might be $25,000 or $5,000 or $50,000. I've seen minimums of $250,000 or $100,000. So it really depends on the company, how much they're raising, and if they're using one of these platforms. In terms of potential return on investment, it could be anywhere from zero, you lose all of your money over time, or you get 100,000 times return on your money. Holy crap, how does that happen? Well, if you're investing in one of these mega unicorn companies like an Amazon, if you're an angel investor in Amazon and you invested $50,000, Amazon's market cap is over $1 trillion. So if you own 1% of 1 trillion, just do the math on that. So that is very unlikely, so you want to make sure you're doing your math accurately. It's more likely that you're going to either lose all of your money, or you're going to make a partial return. So I broke out a scenario. If you have 10 investments, let's say in startup companies, 50% of them will go to zero, right? Here I'm gonna put 10 startups, and there's a good chance that half of them are gonna get you nothing. And then maybe 40% of them break even. So in the future, they sell or they go public maybe, something like that. Private equity buys them, and 40%, 4 out of 10, are gonna break even. So if you invested $1,000 in each of them, you're gonna get $4,000 back. You're gonna lose $5,000, but then maybe there's a chance 1 in 10 are gonna have a magnificent skyrocket valuation in the future. They go public, and it's a winner, and maybe that company will 10x. So you're gonna make $10,000. Which is amazing off of a $1,000 investment. Maybe you're gonna be in that lucky group and you're gonna make 100x, 1,000x, 10,000x, 100,000x. Keep in mind that happens over a longer period of time, and oftentimes it's really risky to bet on this kind of a scenario. I just mentioned 50% of these investments will fail. That's another reason why you don't want to invest in only one startup. You want to build a portfolio. Similarly, you want to build a portfolio of public companies and of cryptocurrency. I would say the portfolio is probably less important on the crypto side, more important on the startup side, and also very important on the publicly traded side of things. Now, how can you actually get invested? I mentioned $50, actually 50, not 100. You can get started on some of these sites. Republic, which is one of them, all the way up to $25,000 or $100,000 minimum. In terms of the risks, it's a limited time frame. So like I mentioned, you can only invest for maybe a month or 2 months or 3 months, sometimes 6 months. Oftentimes it's a really short window that you can actually invest. And then your money's locked in. You can't get the money out. So that's a huge risk, because in a public company, like I mentioned, you can sell out at any time. Even if you lose money, you can get some part of your investment back unless the company goes completely bankrupt. In a startup investment, you don't have that chance. You invest in the company and it's a marriage for life until you get a return. So keep that in mind. In terms of where you can actually invest, I listed out some websites. There's one called WeFunder, which is where I've made a majority of my investments and where I've raised capital for my business. There's a platform called Republic. That's the one that I believe you can invest for as little as $50. There's Start Engine, Seed Invest, AngelList, and a number of other platforms out there. If you're on the more sophisticated side of things and you're making investments of larger dollar amounts in startups, you should be networking. That's the key. If you're a high wealth individual, meaning your net worth is above $5 or $10 million, and you're looking to invest $25, $50, $100,000 in a single startup private company, you're gonna have to do some networking in your local city. There's a number of different angel investing groups. Do some networking, put yourself in the community, and the deals will start to come to you because entrepreneurs are hungry, and they are looking for your investment dollars. In terms of final thoughts here, it's really important to diversify. So I did mention that in 10 investments, maybe 5 of them completely fail, maybe 7 of them fail, maybe all 10 of them fail. So if you're not building a big enough nest, you're not going to set yourself up for success. Similarly, in the public market, you want to have that diversity. You want to have a small allocation to a larger group. So don't invest $10,000 in one company. Again, this is not my advice, but I would never invest $10,000 in one company. I'd rather split that up into 10 different companies. And finally, invest in what you know. I think that makes sense for all 3 of these asset classes. If you really don't understand something and it doesn't make any sense to you, that's probably not a good investment for you. Maybe it's a great investment for someone else, but not for you. I could actually say that's probably not as true for the public market. Some good examples are these mega cap companies like the Apples, Googles, and Microsofts of the world. Maybe you don't fully understand how Google actually makes their money, but the last 20 years have shown really predictable results, and maybe it makes sense to throw a little bit of your allocation in Google stock. Not that I'm telling you to do that. However, you might not fully understand some of the technicalities of how Microsoft makes their money. That's okay. Microsoft's a great company, and go ahead and do that. In a startup, I would definitely not recommend doing that because you're not going to really understand what the market is, how you can help the entrepreneur besides just giving them money. So that's something that I would definitely encourage you to think about. Final thoughts in terms of all 3 of these. When it comes to making allocations, I did mention in terms of, cryptocurrency, there's Bitcoin and Ethereum. These are 2 of the biggest ones. So maybe hypothetically for me, let's say I'm invested in 2 of these. And then when we move over to public companies, maybe you have a basket of 10 to 15 companies. And then you move over to startups, and maybe you're going to invest in 10 per year. And so over a 10-year window, you've made 100 startup investments. If you guys want to learn how to invest in startups, it's actually my most popular video here on YouTube. So make sure you check it out, linked in the description below. Full overview, how to invest in startups. I've also done a few different videos on equity crowdfunding. What is equity crowdfunding? How you can raise capital for your business. I believe you can raise up to $5 million now. So if you're an entrepreneur looking to raise money for your company, make sure you check out that video. And finally, let me know what questions you guys have in the description below. Thank you so much for your time, and thank you for watching this video until the very end. If you haven't already subscribed yet, what are you waiting for? Subscribe to the channel, like this video, and I'll see you guys next time. Keep hustling.